Next, what we're going to do is we're going to calculate what's called the discount rate to figure out what our enterprise value is from doing a discounted cash flow analysis. So to do that, we have to calculate what's called weighted average cost of capital. And you have videos out there that show you how to calculate the weighted average cost of capital in an example. So for the weighted average cost of capital, we click on our WACC here, which it's just referred to, but it's weighted average cost of capital. You have to find the capital structure of total equity within the firm, total debt within the firm, calculate the cost of debt within the firm, and the cost of equity within the firm. So to calculate the equity total in our capital structure for the firm is you take the total shareholders' equity over the value of the firm, which is total assets. So on here, we go to the balance sheet. You can reference this formula here. You're going to take total shareholders' equity, which is 221 or 221,000, over total assets, which is 247,500. That will give you a total of 89%. To calculate the debt over the total value, which is going to be the capital structure of debt, you're going to go to the balance sheet and take total long-term debt, which is 25,000, over the total assets of the firm, which is 247,500, which is going to give you 10%. Long-term debt is the proper thing to use for doing a debt over total value of the firm as opposed to total liabilities, because it gives you a truer picture of the cost of debt, especially over long-term projects. And for looking at total enterprise value, you're going to measure the total debt. The next is going to be the cost of debt. Typically, you can use the percentage of a long-term bond that a company offers. In this specific example and on your case study examples, you can also use the long-term debt of, say, a bank note. Within Larry's telling, we know in the company info that the interest rate on a bank note is going to be 6%. And you'll see that in the case study. So you go back to the weighted average cost of capital, the cost of debt will be 6%. So in the next video part, we'll show you how to calculate the cost of equity.